Now, let me explain the Astrea PE bonds. Astrea PE bonds are bonds that are backed by cash flows from portfolios of private equity funds. For each Astrea transaction, the portfolio value is more than twice the value of the bonds issued. We as sponsor continue to own the funds and maintain 100% of the equity in the portfolios. Each Astrea has a similar structure. Every Astrea transaction is backed by a portfolio of PE funds that is diversified and of good quality. Bonds are issued from this portfolio. Using Astrea 5 as an example, the Class A1 bonds were issued to retail investors. This and other tranches of bonds were offered to institutional and accredited investors. As mentioned before, Azalea retains and owns the equity in the capital structure. For example, Astrea 5 was issued at a debt level of 45.3%. In financial jargon, this means that the loan-to-value ratio, or LTV, is 45.3%. Each Astrea is a stand-alone transaction. This means that the default of one Astrea does not affect the other Astreas. As mentioned earlier, the bonds are backed by cash flows from PE funds. However, to understand the bonds better, you must also understand the pattern of private equity cash flows and the risks involved. Let's start with what are private equity funds. Private equity funds are funds that are managed by professional managers, also known as general partners or GPs. Each fund has many investors that provide capital. These investors are also known as limited partners or LPs. The managers of these funds then use the capital from LPs to invest in a portfolio of private companies. During this period, they will use their knowledge and expertise to add value to these companies, after which they will sell these companies for a profit and distribute the cash proceeds to their LPs. In the context of Astrea 5, when the underlying investee companies are sold, the cash flows received are used to pay Astrea bondholders based on a defined order of payments. This is also known as the priority of payments. One thing to note is that the cash flows from these PE funds are not predictable. To mitigate that, Astrea only invests in mature funds that are more cash generative. Let me show you how it works. Here you can see the typical cash flow profile for an investor in a private equity fund across its fund life. In the initial years of the fund, there will be cash outflows as the GP draws capital to fund their investments. These cash outflows are represented by the red bars. Over time, once these investments grow and become profitable, the GPs sell them and generate returns for the fund, distributing cash back to investors. These cash inflows are represented by the green bars. The later years of a fund life, where the cash inflows are more than the cash outflows, is also known as the cash generative phase in the life cycle of a PE fund. The net effect of the cash outflows and inflows is represented by the pink line. This is also known as the J curve because of its shape. To ensure more certainty over cash flows, Astrea portfolios only consist of PE funds that are in the mature phase of their fund lives when they are more cash generative. The portfolios are diversified with many underlying investee companies and are managed by quality fund managers. Now to understand the risk of loss of the Astrea PE bonds. The bonds are issued at conservative loan-to-value ratios. It is important to note that the LTV for each Astrea at their points of issuance has always been around 45%. This means that the portfolio needs to lose 55% of its value before bondholders are impacted. As you would know, not all tranches of bonds are ranked equally. The Class A bonds rank more senior than the Class B bonds. This means that the portfolio needs to lose 65% of its value before Class A bondholders are impacted. However, the risk of the portfolio losing 65% of its value is extremely low, as the Astrea portfolio consists of mature funds. Historically, portfolios of mature funds have demonstrated only a 2.3% chance of loss. Moreover, for the 2.3% of these funds that lost money, the worst performing fund only experienced an actual loss of 17% in value. So even if we assume Astrea is one of these worst performing funds, the loss of 17% will not affect bondholders and will only affect the equity holder. Thus, you can see that the conservative LTV of Astrea PE bonds helps to lower the risk of loss to bondholders. In addition to having a conservative LTV, there are a number of safeguards that have been put in place for each Astrea transaction to protect bondholders. The first of which is to set aside a regular amount into the reserves account every period until sufficient reserves have been accumulated to repay the Class A bond principal amounts. Secondly, the transaction has a sponsor sharing feature. This feature allows faster build-up of reserves that facilitates redemption of the Class A bonds on the expected date of repayment of the debt. Thirdly, there is a maximum LTV ratio of 50% to ensure that there are at least twice the amount of assets to cover the debt. Lastly, the transaction has a credit facility to allow the issuer to draw from the bank to pay key expenses of the structure, including the interest payments of the bonds in the event of cash shortfalls. So what are the risks related to investing in Astrea PE bonds? As with any investment, there are risks. The first is investment risk. This is the risk that stems from the nature of the PE fund investments, namely that the amount and timing of distributions from the funds are uncertain. The second is market risk. This is the risk of adverse macroeconomic conditions affecting the performance of the underlying PE funds. As you would have witnessed, the COVID-19 pandemic has caused and continues to cause severe disruption to global economic activity. As a result, sectors such as tourism, aviation, retail, and live entertainment events were badly hit, which would affect the performance of PE funds with portfolio companies in these sectors. Lastly, there is leverage risk. PE funds are likely to use debt when making their investments. Should there be adverse macroeconomic conditions affecting their businesses, their ability to pay off their debt may be affected. To sum up, The key risks relating to the Astrea PE bonds are investment risk, market risk, and leverage risk. With that, this ends the segment on the introduction to Astrea PE bonds. Now I will hand the time to En Yao, who will give you a general market update for 2020.